Hi there, welcome to my channel. Well, here's an update on my portfolio. We're at $308,164 so far today, and as you guys know, the main idea here with my portfolio is collecting dividends, collecting income now, because I need income now. And so on average, I'm making about $5,700 a month currently. And of course, my goal is to reach $10,000 a month from my portfolio, which should be achieved in about a little bit over 2 years. So I'm, really looking forward to that, and maybe I can speed up the process by investing my entire paycheck on a weekly basis, as I've been doing so far. Every week, I get paid, and I invest it completely into the market. And so let me just show you my actual Robinhood portfolio here. Here it is, and let's open that up. So let me just show you, the guys, that the numbers are correct. Yeah, there it is, 308,000. This one's a little bit more, I guess, up 0.27%. On this side over here, we are up 0.31% today. And so today I wanted to talk to you guys about ETFs that would crash less than what the market would crash, because I was thinking about there's lots of optimism. There's lots of people saying that we're just going to go right and back into a rally. If you heard my video yesterday, there's a 100% chance, based on history, because of what's happened in the past. I guess it was back in the 80s or something, when markets were at all-time highs and rate cuts were initiated, a cycle of rate cuts. Just like this time around, I guess there's going to be at least 2 more cuts this year, and for sure another cut going into 2026. And so in the past, when that has happened, markets are at all-time highs and there's a cycle of rate cuts, and it has already begun. In a scenario like that, there's a 100% chance that over the next 12 months the market is gonna rise. So by this time next year, by September of 2026, the market should be far higher than it currently is. I saw an estimation on Grok, after asking Grok the question if the market is going to rally after rate cuts, and it mentioned anywhere from a high of 13% to 11%. Okay, none of this is financial advice. This is just for entertainment purposes only. But if the market does 11% from here, I should be at like 275 by September 2026, if it does about 11% return. SPY and QQQI should almost be close to about $60 each. A little bit under $60 each, but fairly close. So that's pretty exciting, and due to the chance that due to this kind of scenario is like 100% chance that the market's going to continue to rally from here, that's very positive news. But of course, there's people who, there's always people who have I guess the bear sentiment that don't think there's going to just continue to be a rally. There's something bad's going to happen or something. So there's always both perspectives on the market. For me personally, I think it's positive. I think things are going to go in a good direction. Things are going to be positive. Personally, I believe that. But there's other people who believe that, we could see a pullback and a correction, and who knows what else, right? There's always the other perspective. So I guess you always have to be ready for both directions. You know, when it comes down to it, I guess the main thing is to be ready. If the market goes up, be ready to participate in the upside. If the market goes down, then be ready for that situation as well. And so that's why I've been looking into ETFs that either crash less. For example, there's this ETF that I was looking at. It is in this list that I got down here. Let's see, here it is. Less downside. Okay, so one of the ones that I was looking at here that has less downside, it was in the this one here, consumer staples. So if we go to back in 2008, which was probably one of the worst crashes in recent times, back in 2008, the S&P 500 crashed by 50%, while this ETF only crashed by 15%. So if we go to maximum here, I believe it's right here. This is the 2008 crash. It looks very small by comparison to how far the market has gone now, but this was a, as I read it on Grok, it suggested that this crashed 15%. Although here it says it's only down 2.25% during this crash. But if we look at the S&P 500 back in 2008, I believe the S&P crashed by 50%. So if we just go to SPY and we go to the maximum, we can find the 2008 crash, and it's right here. And so this is the crash right there. So as you guys can see, it was a close to a 50% drop. Here it says 45.56. Okay, so I'm looking for ETFs like that ETF that is based on consumer staples. And basically consumer staples are like everyday things that you need to buy. You need to buy toothpaste, you need to buy toilet paper, you need to go to the grocery store. There are certain things that we just need to have, and we're going to buy them whether the economy is doing well or whether it's not doing well. We're going to buy those products because we need them, and those are considered consumer staples. And that's why an ETF that is concentrated in consumer staples crashes less than the S&P 500. So there's a lot of different ETFs that crash less when the S&P 500 crashes, because back in 2008 the S&P 500 crashed close to 50%, but an ETF like that one that was based on consumer staples only crashed about 15%. So that brings a little bit more stability to my portfolio. Another really I guess contrary play that I saw is gold. So I do have an ETF that is based on gold that pays a monthly dividend. If we go here to the top, it's should be around here somewhere. It's right here. It's a NEOS ETF. NEOS Gold High Income ETF. So this ETF doesn't have a very long track record because it's a fairly new ETF, but it tracks the price movement of gold and pays a really great dividend. If you guys want to see just how much it's paid down here, let's go down here. I don't have that many shares, but as you guys can see, back in August it paid me 51 cents per share, so I made a little bit over $11 on this ETF. I don't currently own that many shares. I only own 22 shares of this, but I'm probably going to be buying more of this. It's based on gold. And so I made a comparison over here of gold, the same ETF, but this is the actual ETF. It's IAU. That's the actual gold ETF. And the NEOS version is IAUI. Okay, that's the income version of IAU. But they're both gold ETFs. And so as you guys can see here, the blue line is the gold ETF, and the purple line is the S&P 500. And so here where you see that green dot, or that blue line that's going up, here's the S&P 500 and gold. And so when the S&P 500 crashed back in 2008, gold did the opposite. So while the S&P 500 crashed 50%, gold just skyrocketed, right? It just went up. And so far currently, as you guys can see here, gold is actually doing a little bit better than the S&P 500 right now, according to this line chart here. And so moving forward, I'm going to be buying ETFs that would crash less than the market would crash. That way, it brings some amount of stability to my portfolio, and it kind of allows you to be prepared for when the crash comes. Because although there's lots of optimism, and I'm positive on the stock market, I believe the rally is going to continue. I believe we're going to continue to rally, and I'm looking forward to the rally. But eventually, someday, at some point, nobody knows when, there'll be a pullback or there'll be a crash. So, no one knows when the crash is going to happen. No one knows when that's going to happen. There may be like a select few very good investors who are really good at investing, who may be able to predict a crash, potentially. But me, I'm just an amateur investor. I'm not a professional. I'm just doing this on my own here on YouTube. None of this is financial advice. But I think that eventually, someday in the future, there will be some type of crash. It's unavoidable. But when is that going to happen? I have no idea. It could happen a year from now, 2 years from now, 5 years from now. I just don't know. So the only thing that I can do is be prepared for it, right? Be ready for it. That's really the only thing I can do. And so that's why I am going to start buying some of these ETFs that tend to crash less when there is a crash, but they also have plenty of upside, right? As you guys can see here with gold, for example, and the ETF, which actually pays a monthly dividend that is based on gold. I assume this is going to track gold. It's going to track it, a little bit off, but nonetheless, it's going to track it. And so that's why I'm going to be buying more of this. I'm also going to be buying more of that low volatility ETF that you saw in my previous video, the consumer staples ETF. And so when I get paid my $1,000 per week, I'm basically just going to split that in half. I'm going to take 500 of it and buy something that has greater appreciation and a little bit of crash protection, I guess you can say, something that doesn't crash as hard when the market crashes. And then I'm going to take the other 500 and probably put it into something that's really that pays a high dividend. So that's how I'm going to do it moving forward. I'm going to split that in half and buy something that has greater appreciation and potentially will do better during a crash, and something that will pay a high dividend. So that's how I'm going to mix it up moving forward with my portfolio, and hopefully things will continue to move on up. Of course, the other way to protect your portfolio is with puts. And so I got a bunch of puts here, and more than likely I'm going to be losing about $1,000 on puts this month, because I own all these puts. I paid about $1,000 for them, and I'm probably going to be losing money on these puts, but that's okay. I don't mind. Another thing that I spoke to you guys about in my previous video is buying a long call on UPRO in particular. If the market is going to continue to go up for the next 12 months, I think that buying some UPRO long calls is probably a good idea. So on a red day, I'll probably buy a long call on UPRO. And I'm gonna try to do it in the video so you guys can see how to do it, how it works out. My plan is to buy a long call on UPRO, and it's got to be at least until I'm thinking about March of 2026, which is 182 days away from today. And so I'm either gonna buy the 110 call, which would be about $1,400, or the 115 call, which would cost about $1,140. And so for about a $1,000 investment, you can kind of control 100 shares of UPRO. And so actually buying 100 shares of UPRO would cost it would cost about $11,000 to buy 100 shares of UPRO. And so for about $1,000, you can control 100 shares of UPRO for the next 12 months. And if the market is going to rally for the next 12 months, then it may just be a good idea to do that. And so I'm thinking of doing that. Maybe next week when I get paid, I'm probably going to throw that whole 1,000 at a long call on UPRO, and I'm going to try to make a video about it, so that I'm going to try to make a video when I do it so that you guys can see it. Okay, well, thank you so much. Please do me a big favor, like, share, and subscribe to my channel. I really would appreciate it. Thanks so much for watching. You guys have a great one. God bless. We'll catch you in the next video. Bye.